This is the Daily Market Rundown live from the Tradelo trading floor. It's September the 9th, some highlights from today's show. Nasdaq structures repeating 2024, Japan is the canary in the coal mine, and US job growth revisions are now in focus. Good day traders, welcome. It is Tuesday and it's a calm start to the session. Now, if we take a look at yesterday, I think there was a couple of key signaling sort of things we can take from yesterday's session. Whilst it was a bit of a damn squib boring session, low volume, tighter ranges than expected, there were a few key things to take away from that session. I think one of them is very much about what happened with Nvidia itself. Now, if we looked at the equity session yesterday, it was sort of a session that there was rotation early on, particularly in the US equities. We could see really the S&P at the high of the day with the Russell at the low of the day. Once a little bit of selling in the Russell sort of dipped away and was done, ultimately the equities just staged a bit of a bid, and that was pretty much it. It was a damp squib session, a very muted session, if we were going to summarize it. In terms of course, what the Mag 7 did, because that is our key focus, there's one key Mag 7 that I think is really, really important to pay attention to, and that was ultimately Nvidia. Now, if we look at what the change in the week is so far, we can see it was a muted session. There was nothing really to write home about, but Nasdaq ultimately, it taught us something. Okay, now, if I didn't tell you what chart this was, and you looked at this just purely from a technical standpoint, we would very much agree that not only did we get that close below that key blue line, that key reference point in the market, we tried to climb above it but closed back below it. Okay, I think it's a very, very important signaling. It's sort of you call it a doji day, call it what you want to call it, but it's a day where buyers were in control initially, but yet sellers won the day. Okay, and they won the day below the key 170 level, and that's the level we've been referencing not just yesterday, but of course over the last couple of weeks. So the point is again, it's not to say that suddenly things are going to spark and sell off and collapse in a straight line. That's not how this works. But again, it's updating this idea that the strongest market, what has led this entire 30% rally in the S&P, is now no longer a leader. That leadership is gone. And that matters because at some point, we are going to see this start to impact and drag the indices lower. Now, that being said, is today that day? Perhaps not. I think one thing we've marked down in our calendars here on the floor is very much OPEX, which comes next Friday. It seems like there is going to be a little bit of window of weakness that happens after that. There's quite a bit of gamma exposure that's going to run off, positive gamma exposure that's ultimately going to run off after that OPEX expiry. And so it feels like, if you're going to summarize what's going to happen over the course of the next 7-8 session, it feels like any vol is likely to be short-lived. Of course, we could see some significant fundamentals that change that, but assuming all else equal, all the data kind of comes in line, the reality is that it seems like VIX is going to stay contained until we get through that OPEX expiry next week. Once that clears, of course, you've got the window expiry, we've got that pegging effect that disappears, and then perhaps we do get that little bit of a correction that everyone's expecting, as well as what the technicals are starting to show. Okay, in a moment, I'm going to bring up the Nasdaq chart. There is a pattern that is almost identical to 2024. It looks very, very juicy, and there are a couple of key signals. That ultimately to be aware of. Okay, so let's get across and let's look at some of the, let's quickly actually get that Nasdaq chart up. Apologies. There you can see it. That was the chart I was referencing. You can see that wonderful blue little line there. And you can see, of course, we closed below there on Friday. We tried yesterday, closed back below it. Okay. There's the recap of some of the Mag 7 from yesterday in case you want to take a snapshot. As you can see, mostly a sideways session for the 7 most important companies in the indices. Now, in terms of some of the news, let's get across. There's a couple of things to pay attention to. BOE's Bailey, who is the head governor of the Bank of England, is talking about this idea of considerably more doubt on rate cuts. Now, this matters because this is a central bank that had a split vote just recently when they cut, and it seems like that could be just about it for Bank of England cuts. Now, we know the UK economy is really, really battling, and it's not just battling with these higher interest rates, it's also battling with a fiscal situation. We know those long-dated gilt yields posed a problem late last week. They have since reversed, but it is going to be a very, very volatile sort of autumn period for the UK market. So keep an eye on that. I think the pound is one of those that's been a bit of a head scratcher for me for all year. Fundamentally, I do not understand why it's holding up so well relative to the euro. Against the dollar, of course, it makes sense because the dollar is just weak. But against the euro, I feel the pound has held up quite well for now. Okay, I think that's the key, for now. I think there is going to be some volatility at some point this year, but for now, just keep in mind BOE's Bailey is kind of leaning into this idea that it's probably not likely we're going to get cuts anytime soon, because we do actually have to get some stabilization in the inflation data. In terms of then Bank of America, he's talking about, of course, Mag 7 is still and always was and has been perhaps for the last 2 years the most crowded trade. Okay, it's a one-way bet. And again, we always have to ask ourselves, is that justified? Yes. Okay, they're all cash cows. They all produce fantastic earnings. They all revise those earnings and project future growth earnings that are wonderful. So absolutely it should be a crowded trade. And so what we have to do as traders is diagnose or hypothesize what changes that. What changes the scenario in which the Mag 7, which is a crowded trade, is now no longer worth being exposed to? Well, one thing that comes to mind is, of course, we know that AI is the hot trade on the street. We know that the amount of capex expenditure that's going into these chip purchases is significant. We are going to have Q3 earnings at some point, and when we look at those earnings and we start to look under the sort of the cover, if Nvidia was to start talking about a slowdown in demand or anything along those lines, ultimately that would change the hypothesis. Are we there yet? No, perhaps not. Okay, the point is Mag 7 will stay sexy until we get that shift in fundamentals. We're not there yet. Now, in terms of Cook, I think there's something very interesting to pay attention to. This is an ongoing sort of scenario that we need to be aware of, and I'll tell you why. Of course, we all understand the implications if she gets clipped, but I think if she was to get clipped for this reason, in other words, for misstating her primary residence in order to capture lower mortgage rates, if she was to get clipped, it would be somewhat historically unusual. Okay, what I'm leaning on is if she did get clipped, it's perhaps because there has been some underhanded tactics where someone's been, I don't want to say paid off, but paid off. Okay, the point is if we go look a little bit at history, these sorts of cases being brought in front of a federal judge are hugely unusual. Okay, in other words, if you go back in history all the way to 2017, ultimately, only 20 people have been charged over the last 8 years within 600 cases. Okay, now that's not the unusual part. What's unusual is that of those 20, there was only one ultimately that was a standalone case. In other words, the other 19 were all charges brought against someone on top of other charges. Okay, think someone who had a primary residence suggested it wasn't their primary residence but was growing weed in another residence. So they were charged with multiple charges, and this just happened to be one of them. Okay, the point is the one person that was charged, ultimately he was charged because he was trying to take advantage of some old age home scheme that was keeping people in their houses, and that's why he was charged. Okay, the point is if Cook is put or is fired or is seen guilty, it's not because necessarily the case is justifiably that she's guilty. It's that there is some underhanded tactics. Okay, now why does that matter? Well, if there's underhanded tactics, it really does show us how much influence and pressure there is coming on Fed governors, and also how badly they do want to install some more dovish members. Okay, that's all you have to take away from it. It would be very, very unusual if, of course, she was to be fired based on what we have seen in past convictions. Okay, now in terms of some of the polymarket odds to be aware of, just a few things that stick out. The September rate cut is at 80%. I suspect that should be a little bit higher. I'm not sure why it's so low. I think there's a little bit of an outside bet there that you can be taking on. Yes, you're getting 1 to 5 in terms of odds, but I think that's well worth taking. We do have a 50 basis point cut sitting around 20%, which seems about right given the market pricing is around 10%. And then, of course, in terms of Lisa Cook being fired is around 27%. Like I said, of course it's possible, but I don't like those odds. I think it's going to be very unusual if she's clipped, given exactly what I've just shown you, which is one person's being convicted, and there was a very good reason for that. And then in terms of Powell being fired is quite low. And then I think the total Fed cuts is an interesting one. It's a bit of a head scratcher. Only 41% are talking about 50 basis points for this year, and then 38% for 3 cuts. I think that's very, very low. I think you can probably push the likelihood of 3 cuts this year much closer to around 60-70%. Okay, so there's some things to pay attention to if you like a couple of these side bets, a couple of binary outcomes. They're a little bit of fun, but do keep an eye on those. Okay, then in terms of the key data for today, it's very much about US job growth revisions. There's been a lot of talk about this. The point is that there is some expectation today around this. There is some hedging and some pricing around this. And the general thinking ultimately is that there's going to be a revision to the labor job data creation somewhere between 400,000 to 1 million jobs, okay, and revised down. So the thinking is, if we look from March 2024 up to March of 2025, within that period, the non-farm payrolls data that we receive, the headline data, will be revised down by somewhere between 400,000 and 1 million. Okay, Goldman's is talking around 800,000. And again, I think the way to think about this is that if we go into Jackson Hole last year, and of course post Jackson Hole, we know that we got these revisions as we went into that September meeting, and we know that this did play a role in Powell's decision making. The way he thought about it was rates are very high, they're restrictive at 4.5%, and we had of course not had as strong a labor market as previously thought given the data. And so his thinking was, look, we've seen this slowdown and deterioration over the last 4 months, and now we've suddenly seen a significant downward revision in job creation, and rates are very, very restrictive. Therefore, it probably makes sense for us to be in the process of cutting rates. Okay. You can also throw on top of that it was an election year and perhaps he's a Democrat if you're a conspiracy theorist. Point being is that it did play a role in Chairman Powell's decision making to cut 50. It won't necessarily play as big a role, but it doesn't hurt. Let's say it this way. If the number comes out 1 million today, it will just add more justification for thinking about 50 basis point cuts. Okay, I think the key thing to remember is that that jobs number on Friday was bad. It doesn't matter, if you want to look at the death birth model, whatever models you want to look at. The point is the trend has been very much pointing to the downside, regardless of how you add the numbers up and what birth death models you use. Okay, so should this number come around the top end, and think top end anywhere close to that million mark, I think above 900,000, that's probably going to put the odds of a 50 basis point cut somewhat higher. Now, somewhat, are we going to go from the current 10% to 50%? Absolutely not. Okay. Should we go and hit 1 million jobs revision, downward revision? Perhaps we move from around 10% to 25%. I think that's probably quite a logical move. And then, like I said, you've got to be very switched on for like a Nick Timmer's Wall Street Journal leak, where the Fed will be discussing a 50 basis point cut as an option. Okay, something along those lines. I think that is how this all plays out in terms of sequencing. Okay. Now, in terms of some of the key charts, I think this is a fantastic chart. We spoke about this last week. We spoke about the importance of this 3.55 yield in the 2-year. And we just need to discuss this chart because I think it matters a great deal. We can see we closed there last week for the first time. So we closed down at these levels for the first time in a number of years, all the way back to 2022. And so from a technical perspective, we can also see we are now continuing this one-time framing sequence. So we are in week 7 of a one-time framing sequence. And it's a close below that 3.55 yield. And of course, the market is now starting to price in the likelihood of more cuts than previously anticipated. Okay. The point is technically 2-year is very much looking like lower yields in the near term. Of course, there's a number of data points to navigate, but so long as we stay below that 3.55 yield, you've got to be looking for buying the 2-year in terms of price or selling in terms of yield. So looking for lower yields in the near term. Now, just a couple of things to discuss that I think matter in terms of timing. And we're going to look at last year because last year contextually things were very different to where we are right now. Okay, if we go and zoom out and we look at last year, we can see that moving into the 50 basis point cut we got in September, we can see 2-year yields had gone all the way from 5% down to 3.5%. In other words, the bond markets were pricing in those cuts because they were data dependent and because the data was weakening. Okay, this time round, what's happened? Well, if we go back to that chart, we can see they've started that trend. So we can see for the last 7 weeks, we've moved 50 basis points because, like I said, non-farm payrolls data is weakening. Okay, but that's a 50 basis point move relative to a 150 basis point move. Now, keep in mind, last year, the markets were pricing in 7 cuts in very short space of time. Okay, think 14 months they were pricing in 7 cuts, almost one every meeting. Okay. This time around, of course, the markets are only pricing in 2.5 cuts for this year and another 3 cuts for next year. Okay, so my point being is to get this yield moving lower, to get these yields pushing lower, you are going to need more data to deteriorate and not just perhaps a Chairman Powell signaling, the intention to cut. Okay, the point is that these yields are currently pricing in what the data is reflecting, and you are going to see further deterioration for those yields to move dramatically lower. Okay, but the general consensus, path of least resistance, is definitely back towards that 3%. I think that is a decent target in the near term. But don't forget, these things can turn around. Technically speaking, 355 is important. It is a key break. But should suddenly we see a re-acceleration in the economy, should the revisions to non-farms come up much to the high side next month when we get the non-farms, should the inflation data, of course, come out very hot this week, okay, we do have the potential for a head fake / trap here. Okay, the point is, this is a market to pay very close attention to because it is at key reference points. Okay, now in terms of then the Nasdaq, I told you it looks identical to 2024, and it sounds and smells and just looks like 2024. Okay, cast your minds back, and we need to look at a little bit of history. The low ultimately for pretty much the retracement we had after the summer. In other words, generally this is the idea that seasonality-wise, September is a weak month, and the low point was made in the middle of October around OPEX. Okay, and what you can see around that time is a V-shaped reversal. In other words, there we have the one side of the V, there we have the other side of the V, and then we made ourselves back up towards record highs. Okay, nice extension, breakout, very aggressive rally, and it really just had shallow pullbacks, just could not pull back. And we had a 31% rally in a straight line. Okay, we hovered around the 20-day moving average. We kept rallying. Everyone desperately looking for that pullback. Okay, now interestingly, we tested the 50-day in March, April. We bounced off of it initially. We then closed below it, and we finally had our very aggressive correction in the Nasdaq. It was about 1,600 points. Okay. Thereafter, of course, the market deported around the 100-day moving average, and we then rallied to new record highs, etc., etc. The point being is that we've had that V-shaped reversal. Okay, we can see as well the market lost momentum at the end of 2024 and start of 2025, but it still kept making new highs. Same thing. We broke out. We've lost that momentum now. The market's come back and importantly tested the red line, which is the 50-day moving average. It's bounced off of it. Okay, in the same way it bounced, I'm just going to scroll back here, in the same way that it bounced off that moving average effectively in 2024, you can see it bounced aggressively. And should we start to offer below that now, once we get beyond that OPEX, that 50-day moving average is going to perhaps play a more prominent role than normal. Okay, keep a close eye on this. This is one of those things that once we pass below it, then it should be a good time to start to short the market for that correction that everyone wants. Where it stops, I don't know. We'll deal with that when we get to that point. But right now, keep a very close eye. We have got that lower high. And again, if we go look at 2024, we made the high, we made the lower high, we made the high, we made the lower high. The pattern is very much resembling what we had in 2024. So does that mean we're going to go down? Absolutely not. We're content with what we see today, but we're aware that pattern exists. Okay. And then finally, I think Japan is a canary in the coal mine. This is a chart I took off Twitter this morning. I forget the handle I took it from, but I think nonetheless, it is significant. Okay, Japanese 10-year break-even yields, that's just the inflation expectations looking 10 years out. So if you were to look 10 years into the future, so 2035, at that point, a snapshot inflation is running at 4%. Now, that should scare the living daylights out of you, particularly if you're Japanese. Moreover, central bank policymakers are supposed to keep this expectation at 2% and anchor it at 2% because this is a long-term expectation. In other words, the BOJ is not doing their job. Okay, now does this matter? No, it doesn't, because they clearly haven't been doing their job for some time now. Because if we go back to when this sort of started to accelerate, it was already around April, May of this year. The point is, it continues to accelerate. Now we have a government problem where we've had the leader step down and there's a squabble about who's going to be next in charge. They're all talking about more fiscal expansionary spending. The point is 30-year yields are going to keep rising, and so are inflation expectations. Okay. Now, how this all works is important you understand. There's a bit of a sequence effect that takes you. At some point, the BOJ will have to do something about this. Okay, they'll have to anchor those expectations. Otherwise, you're going to have people with picket forks wanting to kill the government and start a civil war because inflation is going to get out of control. Okay, so what happens here is that we can see right now 30-year yields. Okay, so these are the 30-year yields, the one we've been referencing for some time now. That exact same low matches the low made back in April. In other words, inflation expectations are now driving 30-year yields higher. We of course know that we are sitting at the highs or the highest levels made since, sort of pre-2000, so a good 25 odd years ago. So the point is that these yields are going to keep pushing and pushing and pushing. Now, is this problematic for the Japanese government? It is and it isn't. It is problematic in a sense that no investor is going to want to touch these bonds because yields are not high enough. But it isn't problematic because no investors currently buy Japanese bonds anyways. Okay, but what should happen in terms of sequence of events? Bond investors in Japan do love to hold US treasuries because right now 30-year US treasuries are offering 4.7%. Okay, and you're long the dollar, which is a relatively stable currency. But what will happen with these inflation expectations? If they stay high, the 30-year bond will rise. It'll have to rise to justify those higher inflation expectations in the future. At some point, you'll start to see bond investors want to take advantage of rather owning Japanese bonds. Okay, so what they'll typically do is they'll diversify out of perhaps US 30-year bonds and into Japanese bonds. But first, we need to see these yields move higher. Okay, and this is ultimately what created a carry trade implosion not that long ago, which is suddenly we see a little bit of liquidation of holding offshore bonds by Japanese investors and rather own their own local bonds. Okay, now how does this all play out? Well, this is the Japanese yen. It is a chart we've been looking at. It does look like a head and shoulders, but the key thing to take away is that the Bank of Japan is so far behind the curve. Okay, currently they're sitting at around 0.5% interest rates. Now, if 10-year inflation expectations are at 4%, yes, you're right to think that they are running negative 3.5% real rates. Okay, they are the most negative real rates among the G20, and yet the Japanese yen is not at the weakest levels over the last couple of years. Okay, that on its own should kind of shock/surprise you. The point is that the only way the BOJ is going to get those inflation expectations in line is they're going to have to hike rates. Okay, they're going to have to do it sooner rather than later. Otherwise, the market is going to keep pushing those longer dated yields high. Now, like I said, if the Japanese bond market was a normal market traded by traders rather than just the BOJ, these yields would probably be another 100 to 150 basis point higher. Okay, the reason they're not sitting at 4.5-5% is simply because it is pretty much controlled by the Bank of Japan. Okay, up to a certain point. At some point, they are going to get challenged on that. At some point, they are going to lose control of the situation. Okay, what does this all mean? Well, what will happen is the BOJ will be forced into a hiking cycle. Once these yields tick up to 3.5%, 4%, 4.5%, they'll be forced into a hiking cycle. At that point, we're going to see some significant Japanese yen appreciation. At that point, the carry trade will start to be called into question again. That's the sequence of events. Should you care about this today? No. Should you care about this tomorrow? No. But it's good to know about it because at some point it's ultimately going to matter for us as traders. Okay, that's a wrap for today. If there are any other questions, do post them in the Discord channel. Don't forget, we don't really have any key economic data today. So what that means is you can probably expect a low volume, tighter range day, another boring day, which means it's going to be a scrap and a fight. But that's our job. We sit there, we take what the market offers us. And if that means we just cover our desk fees and take a couple of ticks here and there, that is our job. The highlights of this week will, of course, start tomorrow with that PPI data from the US. And then, of course, Thursday is the main event. Good luck out there today. Go manage that risk. Go make some money.